So here we have a ton of information that we'll use to figure out the weighted average cost of capital. So you've always got to have tax information, information for if you needed to issue new bonds, information about preferred stock, information about common stock, information for calculating the required rate of return. There's another method that we have that needs a bond yield risk premium. And then thankfully they gave us the target capital structure, which 30% debt, 10% preferred, and 60% equity. So those, you already have like half the equation since you have the three weights in the equation. So it's just a weighted average, just like if you were calculating your grade. So here's an example of the three types of weighting structures where target weight structure was the best, and they gave us 30% debt, 10% preferred stock, 60% common equity. And then they show us what the market values are for all three of those and what the book values are for all three of those. So you can see the book value is kind of way off in terms of what you would ever want to have to use for the weighting structure to calculate the weighted average cost of capital. So let's look at the component cost of debt first. And this is fairly easy because all we're going to do is calculate the I on your financial calculator. And what we're trying to figure out is the current cost of debt. So we want to see if we had to issue debt right now in the market, what rate would we pay? And then the reason why we multiply RD times 1 minus the tax rate is because interest expense for firms on debt is tax deductible. So that makes the cost of debt a little bit lower for the firm. And this is the only component cost that we actually do an after-tax cost for. So the information that they gave earlier was that if they could issue new bonds, it'd be 15-year, 12% semi-annual bonds that sell for $11.53. So what's the cost of debt? So we're just going to plug in this information into our financial calculator. If it's a semi-annual bond, then this is 15 times 2 or 30 for N. The present value is the price they gave. The payment is 12% of 1,000, which is $120, divided by 2 because it's semi-annual. So that's where we get the $60. And then the future value is 1,000. So we compute I and we get 5. And remember, that's a 6-month rate since it's semi-annual. It's like the periodic rate. So we multiply 5 times 2 and we get 10%. So 10% is our RD that we'll use in the equation. So the tax rate they said earlier in that one big slide with all the information was 40%. So the after-tax cost of debt is 10% times 1 minus 0.4, which gives us 6%. And the flotation costs in this chapter for debt, we'll just ignore them. That would be the cost of, getting someone to help us issue debt. There is a small cost for that, but we're not going to consider that. So the next component piece that we need to find is the cost of preferred stock. So we don't have any after-tax situation here, and so we just need to go and find the formula that we were just looking at in the previous chapter, which is RP, the cost of preferred stock, is equal to the dividend divided by the price of preferred stock. And it's the current market price. And in that information slide that had all the data, the dividend for preferred stock was $10 and the price for preferred stock was $111.10. And so we get 9% for the cost of preferred stock. And then we get to a question: is preferred stock more or less risky to investors than debt? Well, the non-mathematical way to talk about this is just that you look at the fact that if a company can choose not to pay its preferred dividends, that makes it more risky for an investor, because for debt, a company really can't choose not to pay their debt. They start getting in serious trouble. So And think about if the company can't pay the preferred dividend, then they can't pay their common dividends. And then all the stockholders will wonder what's wrong. And then if the company needs to raise more money in terms of for projects, then they'll have a hard time doing that. And then preferred stockholders can get mad and try to take control of the firm. So all in that sense, with all of those that situation that can occur, it's more risky. So then why is the yield on preferred stock lower than debt? Well, the corporate investors own most preferred stock. So companies own preferred stock of other companies. And 70% of preferred dividends that are received by corporations are non-taxable. So they get this special deal. So preferred often has a lower before tax yield than the before tax yield on debt issued by the same company. But the one thing to note is that the after-tax yield to a corporate investor and the after-tax cost to the issuer are higher on preferred stock than on debt. And then finally, we get to the component cost of equity. And one thing that you might wonder is why there is a cost for retained earnings or common equity. Well, a company's earnings can either be retained and reinvested in the business or paid out as dividends. So if earnings are retained, then shareholders forego the opportunity to receive cash and to reinvest it in stocks, bonds, or real estate. Therefore, the company should earn on its retained earnings at least as much as its stockholders themselves could earn on another investment that's of equal risk. Also, the company's stockholders could invest in a company's own common stock where they could expect to earn the required return on stock. So, retained earnings have an opportunity cost that is equal to the required return on equity, and that's the rate of return investors expect on the firm's common stock. So now we're finally to the third component of the weighted average cost of capital, and this is to determine the cost of common equity. And so we have three different methods to determine the cost of common equity. The first is the CAPM, which you should recognize this formula. The discounted cash flow approach, and this is just the constant growth model rearranged to solve for R. So this is that same equation as P0 equals D1 over R minus G. And then the third method is the bond yield plus risk premium. So it's pretty simple. So the first method is to use the CAPM. And so you have the risk-free rate, the market risk premium, and the beta. Whenever you see the risk-free rate and beta together, you know you're going to use the CAPM equation. So the risk-free rate is 7% plus, and the market risk premium, that means the return on the market minus the risk-free rate, is 6%. They've already subtracted the risk-free rate, and multiply it times the beta, and that equals 14.2%. So we have one estimate for the cost of common equity. The second estimate is found using the discounted cash flow approach, and so they gave us some information here for D0, price, and the growth rate. Since we only have D0 and we need D1 in the equation, we need to solve for D1, and that's just take D0, $4.19, times 1 plus the growth rate. So now that we have D1, we substitute that into this equation, divided by 50, and then you'll get a decimal number here, and then you add plus 0.05. So just be careful here to always do D1 divided by P0 and then add the growth rate. And so you get 13.8 as a second estimate. And then what about if we had a non-constant growth? Because this was assuming that we had a constant growth stock. So it is something that you can do. You need to use Excel to calculate this, but we're not going to do that in this class. And then we have the final method, the bond yield plus risk premium, and you just take RD plus a risk premium, and they usually tell you, well, in the questions here, they tell you the risk premium. So usually the risk premium is from 3 to 5%, and so they've chosen 4. So we're just adding 4 and the rate on debt of 10, so we get 14%. Now, since we have 3 different estimates, the best thing is to do all 3 and just take the average of the 3, or they suggested using the midpoint, which is actually the same thing as the average in this case. So they're going to choose 14%. Usually we take the average.